Hey, welcome to the channel. Jasper here again. I'm going to be talking about dividend stocks and growth stocks and what the difference is and how it can help a small pocket investor like myself or anyone else out there who's, doesn't really have quite the same capital as some of these big pocket investors out there. So we're going to talk a little bit about the way that growth stocks could really benefit your pocket and help a small pocket investor with maybe $500, $100, or $1,000. So the main couple things about growth stocks is that sometimes they come with high risk, which also means that they come with high reward. We know that high risk and high reward means that sometimes you might be buying into something that could fall apart just in a couple minutes, couple hours, or you might think over a couple weeks or months that this stock is going to continue to go up. Sometimes we're not always right. We know that, alright? So I'm just going to cut to the chase and talk about how you can find a stock that does have good looking growth for its forward or future growth and has a lot of potential. So we're going to talk more in depth in the future on this about how to really pick a stock, but right now we're just going to talk about what the difference is between a growth stock and a dividend stock and a value stock, and how value stocks can sometimes be a dividend stock or a growth stock, but most growth stocks are going to be outpacing the rest of the market. They're going to be possibly undervalued and have a really nice industry sort of disruptive sort of business model that's just going to change and shake things up and do something totally different that no one else can really replicate. Value stocks are companies that usually have their business already sort of formulated and people already know this company has done its growth and it's already sort of established itself in the market. It's got maybe a $40 or $50 value tag on it, but maybe it's not really going anywhere for a while. It's gonna sit there and sort of has a stagnation period. Value stocks can be growth stocks in the future, especially if they are using their money to sort of focus on research and development and things like that. A growth stock is going to be something that's they're cash burning. They're spending a bunch of money for research and development. They're trying to create something innovative, or they've got some sort of product that they're raising money for and they're trying to finally turn a profit. Maybe they're in their first, second, third, or maybe even fifth year of business and they aren't quite making profit yet, but they're on their way to being a giant valuable company in the future market of whatever industry that they're in. So whether or not that's some sort of clean energy, some sort of health therapeutic, maybe it's just a t-shirt company or some sort of online service that can help people, those kind of companies that are starting up and they have very little sort of value behind them, these companies can really do a really great job over the long term or even the short term if they have some really cool things coming up or announcements. Maybe they're finally about to make some profit and their earnings are coming up and you can see that in their balance sheet, something like that. So that's just a quick little bit of a basics on this and that. Now I want to say the really good thing about growth stocks is that sometimes a growth stock starts to do this run up where someone heard something from a bird or from their friend, or they just read it on Reddit or Twitter or something like that. So hype gets into a stock, right? And then it starts going up and you can see that it starts going up and it's all the way up there and you're like, wow, that looks like I should get some of that, because where's the top? It can just keep going up. If you chase a stock and you just bought into it with no real fundamentals behind it, not really understanding what's going on, you can really end up in a bad position. I just actually ended up in a pretty rough position the other day after buying into a stock that had just run a couple 100% over multiple days. And then I bought in. I got greedy. I could have sold and made about $300 on the day, and I didn't. I ended up losing all of that profit The following day, I was still holding the stock, and then it fell apart the next day. I lost $300, a total of $500 off the top of my profit. It was a pretty risky move. I thought it was going to pay off. It didn't. All right. So there's companies that might have a lot of hype behind them, and all of a sudden something crazy happens, and a lot of buyers and inflow of volume and buying volume sort of just picks up. That could throw a stock way off of its regular trajectory or trend pattern, where it's going up at a very nice consistent rate, and then all of a sudden it gets too crazy and then it crashes back down. Now, doing a run throughout the day is really not a bad thing, because that can show you that if people are interested in it right then and there, they're looking at it for a quick speculation of it's going up, so I'm going to buy some. A lot of these people, they have a lot of capital, so when they're swinging in, they're buying thousands of shares. So a single penny ends up being $100 for them sometimes when a share price changes just by a single penny. So these people, they're big leaguers. They have a lot of money in these stocks, and some of them, they're making hundreds of thousands of dollars on just a stock moving maybe even just $1 or $10. Depends. But supernovas, they happen on the market all the time. It's just how you gotta get to spot them. Now, that's day trading though. What if you see a company that is starting to really change its fundamental basic values and really start to change the way that they operate, and they have future growth ahead of them? The stock price has hit a bottom, and over maybe a couple days or weeks or even months, you see that this growth is just going to continue to grow, and you want to hold as many shares as you can because you see this company in the future as some sort of industry leader. They might have $1 billion future for their market cap, but right now they're sitting at like maybe $10 million, and you see that future. You can see that they are going to get there. That's ideally what you want to find in a company, is something that they're constantly working towards some sort of future goal. You can see it. They're updating. There's financial reports coming, and they have looked better and better in the previous years or previous quarters, and you can just see that they're going to do well. Now, these companies, like I said, are going to be better for a smaller investor. A large investor, a big pocket spender, they're going to be more likely to be buying value stocks or dividend stocks because they're safer bets. Most of those companies have all of their growth behind them. They might spend some of their money on research and development, but that doesn't mean that they're going to have any breakout, industry-changing sort of moments. And if they do, it's very possible that a company that's maybe like Procter and Gamble or Johnson & Johnson or AT&T even, those are some dividend companies that could eventually, especially AT&T, make some really big industry changing, disruptive tech or disruptive innovations. Anything that just comes out and you're like, wow, these guys really have some sort of crazy product that is going to change the world. And I think those companies are very good for people who have capital. If you have $20,000, you can put $5,000 in a bunch of different companies, so 4 different positions. Pick your favorites and just hold those companies forever. Reinvest your dividends, and you're there. All right. By the time you're 60, you've got a good couple $100,000, especially if you're adding more and more money and not just letting that $20,000 just do nothing. You want to keep adding money, but we're just talking about the actual, the difference between growth and dividends. So, dividend stocks, they've, like I said, they have their growth behind them. The return of investments might be a little bit smaller, just because it's probably going to be a 2 to maybe 5% dividend that they pay out. So for every $100, you might get 2 or 5. The thing is, with share price volatility, if it falls downward, you get less money. But a lot of people will argue that that is the opportunity to buy more shares. So dollar cost averaging is a really important thing to remember if you are doing that. I think that it's possible for a small pocket investor to be a dividend investor, as long as they're consistent and they are buying not all the time, but when they have good opportunities and they can see the bottom is near, and so they aren't going to be holding on to the hot, jagged, rusty knife, and just cutting themselves and burning themselves more and more on, trying to hold on to something that only damages their portfolio. Dividends as well, another thing is they have small growth, so you need to have big cash. And like I'm saying over and over, for big growth, you can have small cash. You can find something that's going to do that 100% over 5 days or 1 day or a couple months. Whether or not you're a day trader or a swing trader, it's still a growth stock that you're looking for compared to a dividend stock, unless you have a lot of capital. So it's a hard market out there for the small pocket investor, because when you look at dividends, they are unappealing to the average person who doesn't have that much capital. It's going to be that much more difficult for you to turn a profit or make any distinct gains in the right now. And so in the future, when you do get to a certain point with your portfolio, it would be smart to get dividend stocks and re-diversify and get a little bit of easy passive income where you have to do nothing. You just hold the shares. And so that is something that you want to work towards. I'm not saying you don't want to trade dividend stocks. You want to buy dividend stocks, but you can't do it without capital. So it's really important to focus on growth right now, as far as I'm concerned. And just don't forget to just keep working forward. You've got an idea of any industry leader, potentially. Invest in them and continue to invest in them, because growth stocks are going to do exactly what Tesla, Amazon, Google, Apple, Microsoft, Nvidia, all of these companies were growth stocks. They all had growth in front of them at one point. And at this point, Apple, it just looks like Rockstar Games with GTA 5. It's been the same thing for 15 years or something. And, Apple products, don't get me wrong, that's an iMac. I know. I love Apple products, but they don't have that much growth behind them. They've got steady revenue. Wait, I said that wrong. They don't have that much growth in front of them. They do have potential with the health sector, of course, if they do get going with this Apple Watch that apparently is supposed to be able to help with checking your blood sugar. But apparently there's a patent that, or something with the patent that makes it so that they can't do it because it's not an actual medical device. So they have to get the right kind of licensing for things like this, and it's definitely a hard industry to do that. And so there's a lot of things to think about when it comes to dividend investing, especially if you don't have very much money. And the idea is to make money on the stock market. You don't want to have the stock market be treating your money as if it's a savings account and it's just giving you a 2% or 3% return. That's not doing anything for you. So that's sort of all I have to really say. Most dividend stocks really, they're kind of just shelf stocks. Like, oh look, here's my deodorant. It's Old Spice or Axe or whatever, oh, here's my Colgate, toothbrush. There it is. Oh, I've got my L'Oreal shampoo and my Johnson Johnson, whatever. All of these things are just, maybe Tupperware. That's got some growth probably in front of it. I saw that during the whole Corona thing. It was like, man, this is a play, and sure enough, it moved around quite a bit. And then, Crocs. That's a company that I think has a lot of future growth in front of it. It's already very well established, but I think that beyond being a value stock at this point, it is a growth stock. It's still got a lot of growth behind it or in front of it. That's really all I've got to say today. I do want to say, of course, I am not a financial advisor. I'm not telling you to buy any of these stocks. They're just good examples, in my opinion, of what something might be good to buy into. And really, I'm just here to share my ideas with you guys, what I think. Please feel free, comment down below. Let me know if you agree with me or disagree. Start a conversation. I want to be able to talk with you guys, see what people really have to think. And whether or not you like my ideas, am I just a, rambling idiot, or do you think I maybe have the right idea? So that's really that. I want to just say thank you. If you watched the whole video, especially, thank you very much. It helps me out more than you even know. Like the video, comment, subscribe if you want to see more. I'm going to be doing more videos. I'm going to be trying to upload maybe 2 or 3 times a week right now. Life's pretty busy, but I want to try and sort of knock off all of these little tasks. I've got all these little different things that I keep, reminding myself of what I want to try and do, and I'm just using my little sticky notes because I think that's a nice way to just remind yourself kindly to continue to grow and always focus on yourself and focus on the things you want to do. So I hope this video helps someone out one day, maybe. And yeah, enjoy. Peace.